Job overhead and profit are essential components of any electrical contracting business. Understanding these costs and how to calculate them accurately is crucial for pricing jobs competitively, ensuring financial stability, and maximizing profitability. Job overhead refers to the indirect costs associated with performing a job that are not directly related to materials or labor. These costs include, firstly, rent for office space and storage facilities; secondly, utilities such as electricity, water, and gas; thirdly, insurance including liability, workers' compensation, and property coverage; fourthly, marketing expenses for advertising, website maintenance, and social media activities; fifthly, equipment costs for tools, vehicles, and machinery; sixthly, office supplies such as paper, pens, and toner; seventhly, salaries for administrative staff and project managers; eighthly, travel expenses for mileage, tolls, and parking; and ninthly, permits and inspections fees required for project completion. To calculate job overhead, divide the total annual overhead costs by the total annual labor hours. This will give you the overhead rate per labor hour. The overhead rate is equal to the total annual overhead costs divided by the total annual labor hours. For example, if your total annual overhead costs are $500,000 and your total annual labor hours are 100,000, your overhead rate would be $500,000 divided by 100,000, which equals $5 per labor hour. Profit is the amount of money earned after deducting all expenses, including materials, labor, and overhead. It represents the return on investment for the electrical contractor. To calculate profit, determine the desired profit margin as a percentage of the total project cost. The total project cost includes materials, labor, overhead, and any additional expenses. Profit margin is equal to the desired profit divided by the total project cost, multiplied by 100%. For example, if you want a profit margin of 10% on a project with a total cost of $100,000, the profit would be 0.10 multiplied by $100,000, which equals $10,000. When pricing jobs, it is essential to factor in job overhead and profit. The formula for pricing a job is job price equals materials plus labor plus overhead divided by 1 minus profit margin. For example, if the materials cost $20,000, the labor cost is $30,000, the overhead cost is $15,000, and the desired profit margin is 10%, the job price would be $20,000 plus $30,000 plus $15,000 divided by 1 minus 0.10, which equals $75,000. Understanding job overhead and profit is crucial for electrical contractors to price jobs competitively, ensure financial stability, and maximize profitability. Accurately calculating these costs enables contractors to make informed decisions and manage their businesses effectively. By following this guidance, electrical contractors can optimize their pricing strategies and achieve their desired financial targets. The concepts presented allows for more precision and profitable ventures.